Afternoon. Sally here, Max. Elliot here. Jaylan here. Nico, not yet. Val is excused. Andy here. Tom here. Olivia here. Laurel here. Moberly here. Rosie here. Django here. And Alice. All right. Okay, we're gonna continue with chapter 14. Now, today we're gonna discuss the basic currency swap. This sort of stuff becomes relevant when there is differences to access to credit markets in the home country versus the foreign country for a multinational. Think about it. Suppose you're a multinational corporation and you're doing business in Europe, let's say Germany, and you want to start a project in Germany, and that project needs to be funded. And since it's in Germany, it's going to create its what you want to call revenue in euros, and for the purposes of risk alleviation, to the extent possible, it would be better if you could fund this project by borrowing euros. The trouble is, since you are a foreign company, the way the banks or the credit markets view you in Europe will not be as good as you are viewed in your home country. That means terms of lending, or the so-called credit spreads. Credit spreads are the rate at which you can borrow over and above the rates of comparable treasury securities, for example. So in US, maybe you can borrow at treasuries +1. If you're gonna borrow for 5 years, you'll be able to borrow, let's find out what the 5-year treasury bills are today. Markets. Today, the 5-year treasuries are trading at a yield of 4.91. So if your spread is about 1%, you'll be able to borrow at 5.91. In general, if you want to look at it based on credit spread, you can look at Fred, AAA spread, for example. If you have AAA credit rating, you'll be able to borrow on average at 0.5 point above treasuries. How about AA? About 0.68, single A. About $1.13 or so. Not many companies are AAA rated. Companies like Apple, Google, Amazon, The trouble is, typically these companies have a lot of cash anyway. They don't need to borrow. Or you may be triple B, which is the lowest grade you can get, but still be considered investment grade. That would be about 60. So if you were a triple B rated company, if you want to borrow for 5 years, you would borrow at 491 plus 160, which is about 651. Okay. But if you go to European market and borrow there, the spread that you're going to pay more than likely is going to be higher because you're not as well known in that banking environment. For that reason, you may want to go into a swap. So let's think about the basic currency swap. A U.S. multinational wants to finance the capital expenditures of its German subsidiary. Project has an economic life of 5 years and cost of the project is 40 million euros. Current exchange rate is 130. Right now it's 106, but that's besides the point. That means the parent firm could raise the equivalent amount of dollars in the U.S. market, which is $52 million, by issuing 5-year bonds, and let's say it is at 8%. Then they're going to convert those dollars to euros to pay for the project cost. The German subsidiary would be expected to earn enough on the project to meet the annual debt service and repay the principal in 5 years. So that part is not a problem, but you have a mismatch of your cash outflows, which are in US dollars, cash outflows, which are in US dollars, because you're going to pay the US dollar denominated debt, your cash inflows that are in euros. That means you are effectively long euro. Because if euro goes up in value, you get more revenue. If you're long euro, if euro goes down in value, you're going to lose money. For example, at the time of this writing, euro was 130. That was 2021. Currently, euro is trading at 106. Let's look at the chart of euro, actually, the last 2 years. This is 5 years. Of course, the book probably was written earlier than that, but about a year and a half ago, euro was trading at 120, 122 range, and right now it's 106. So if you had simply borrowed in US dollars to finance a project in Europe, effectively you would have paid more in US dollars because your euro income may not be enough now to cover your debt service. So what are you going to do? And alternative for them is to raise the money in euro. So go to European market and borrow 40 million euros. That entirely eliminates the exchange rate risk because you borrow in euro, you're gonna pay back you earn income in euro. That's not a problem. The trouble is, unless you're one of those AAA rated companies like Apple, Google, your access to European debt market is not going to be as easy as it would be in US market. So you're going to actually borrow at a higher rate than otherwise. Suppose US parent can borrow the 40 million euro at 7%, but a German firm that is of equivalent credit rating could have borrowed at 6. That means you're paying 1% extra over and above that you would have done otherwise. Well, over 40 million euro, that 1% is 400,000 a year. For 5 years, we're talking about 2 million euros. It's basically you're leaving money at table by doing that. Can we do something about that? When these deals were first done, companies actually found a counterparty that had exact opposite needs. Suppose there is a German firm who wants to invest in US. So they face the same dilemma. If they borrow in euros, they're earning in US dollars, so they're taking euro-US dollar risk. If they borrow in US, they're going to pay over and above what an equivalent company would have paid in US. So there is actually benefits to creating a trade. And that's where what you wanna call the swap has a potential. So suppose this German firm could borrow at 6% in Europe, but if they borrowed in US dollars, they would have paid 9. Okay, 1 point above what a corresponding US firm would have.